Hello everyone, welcome back to the channel. In today's video, we're going to break down one of the most important financial statements in accounting, the balance sheet. If you've ever looked at a balance sheet and thought, this looks confusing, don't worry. By the end of this video, you'll understand what it is, why it matters, and how to read it confidently, even if you're a beginner. What is a balance sheet? A balance sheet is a financial statement that shows a company's financial position at a specific point in time. Unlike the income statement, which covers a period like a month or a year, the balance sheet is more like a snapshot. It answers one simple question: what does the business own, what does it owe, and what belongs to the owners right now? This snapshot helps investors, lenders, managers, and even government agencies understand how financially strong or weak a business is. The core structure of the balance sheet. The balance sheet is built around one fundamental equation: assets equals liabilities plus equity. This equation is the backbone of accounting, and it must always balance. Assets represent what the business owns. Liabilities represent what the business owes. Equity represents the owner's claim on the business. If this equation doesn't balance, something is wrong in the accounting records. Assets explained. Let's start with assets. Assets are resources controlled by the business that are expected to bring future economic benefits. They are usually divided into two main categories. 1. Current assets. These are assets expected to be converted into cash within 1 year. Examples include cash, bank balances, accounts receivable, inventory. 2. Non-current assets. These are long-term assets used to run the business. Examples include buildings, equipment, vehicles, land. Assets show how the business uses its resources to generate income. Liabilities explained. Next are liabilities. Liabilities are obligations, amounts the business owes to outsiders. Just like assets, liabilities are also classified into two categories. 1. Current liabilities. These are debts that must be paid within 1 year, such as accounts payable, short-term loans, taxes payable. 2. Non-current liabilities. These are long-term obligations, including long-term bank loans, bonds payable. Liabilities show how much of the business is financed through borrowing. Equity explained. Now let's talk about equity, sometimes called owner's equity or shareholders' equity. Equity represents the residual interest in the business after all liabilities are deducted from assets. In simple terms, equity equals what the owners truly own in the business. Equity typically includes owner's capital or share capital, retained earnings, that's profits kept in the business. If a company sold all its assets and paid off all its debts, whatever remains belongs to the owners, that's equity. Why the balance sheet always balances? The balance sheet always balances because every business transaction affects at least two accounts. For example, if a business buys equipment with cash, one asset goes up while another goes down. If a business takes a loan, assets increase and liabilities increase. This double effect ensures the accounting equation stays in balance at all times. Why the balance sheet is important? The balance sheet is important because it helps users assess a company's financial strength, evaluate liquidity and solvency, make investment and lending decisions. In short, the balance sheet tells the financial story of a business at a glance. And that's the key concept of the balance sheet explained in a simple way. If you found this video helpful, don't forget to like, subscribe, and turn on notifications for more accounting breakdowns. Thanks for watching, and I'll see you in the next video.